Our guest today is Kris Mitchener. Kris is a professor of economics at Santa Clara University and is an economic and monetary historian. And he joins us today to help us think about what determines the price level. Kris, welcome to the show.
Thank you so much. It's a pleasure to be here. Longtime listener and happy to finally join you on your show. So thanks for the opportunity.
Well, it's great to have you on. As I mentioned, you're an economic and monetary economist and historian. You've done a lot of interesting work on the Great Depression. You've done work on bimetallism, the silver standard. These are all things we want to touch on briefly today. But you also had a paper that was really fascinating about central bank operating losses. And so listeners and watchers of the show know I've spent a lot of time thinking about these losses recently, not just at the Fed, but at other central banks. And what I love about this paper we're going to discuss later today, you actually have a look back at 10 advanced economy central banks, and you show they also went through a period of raising their rates and what happened to their balance sheets during this time to help shed light on what happened more recently here. But before we get into all of that, tell us a little bit more about yourself. How did you get into this career path of being an economist and focusing on monetary and economic history?
So I think it probably started, with a kind of a passion for interdisciplinary approaches to the social sciences. And, as an undergraduate, I liked political science. I liked history. I liked economics. And I found the combination of history and economics super powerful for kind of giving us insights into behavior, both at the micro and macro level. And so I think once then I found that I enjoyed sleuthing around archives and pulling out musty old government documents and constructing data sets, something that maybe will be increasingly a thing of the past with modern technologies. We'll have more efficient ways of doing it. I like that detective story approach to things. And I also think, a lot of topics then, once you get more focused into understanding theory, what really kind of fascinates me both about history and economics is how kind of crisis periods are so, leave such a deep impression on both our institutions and our economy. And so I was drawn to those episodes, and those by their nature, we hope at least, are kind of rare events. I mean, maybe we could argue they're more common increasingly, like in the last 30 to 40 years, we've seen more financial crises. But nevertheless, we still think of these as kind of rare events, which then, makes you shift your lens to longer run perspectives. So one part of me said it was like the interest in understanding these inflection points in society. And another side of me was, kind of probably driven by, folks like Robert Lucas, who said, once you start thinking about growth, you can't stop thinking about growth. So some of my early research was actually on kind of thinking through institutions and growth. And so, I think that's how I ended up in this field.
Yeah, very interesting. You mentioned how important it is to look at a broader historical timeline to really get a rich perspective. And I remember, during the great financial crisis, Niall Ferguson, the historian, mentioned that many people who were working on Wall Street at the time were young. They're in their 20s, and they had no perspective. For them, it was the great moderation. Everything was stable. Everything was normal. To them, they had no concept of, for example, of a national housing crisis. Last time that happened was during the Great Depression, right? So it is important that we look back to history, and people like you help us see the bigger picture and lessons from the past. I mean, we had Ben Bernanke leading the Fed. Unfortunately, he had looked at the Great Depression and some of the lessons. And who's to say another version of history could have been one as severe as the Great Depression had we not had someone who had a historical perspective like he did. And again, that's why it's useful to speak with folks like you.
I think that's right. I mean, I think his perspective was, very useful. I mean, we can always argue about the specifics, but I mean, I think having that perspective that we didn't want to repeat the Great Depression was no doubt important. And, he's the one who ultimately issued the mea culpa for the Fed, after he had been serving as the Fed chair. He issues this mea culpa that, they got things wrong and then, apologizes, not for his period, but more so for historically how the Fed made these famous sins of omission and commission during the Great Depression. So as Friedman famously called them.
And I want to be fair to Bernanke, to the Fed, and just to remind our listeners and watchers that it's easy to criticize the Fed. No doubt about it. They make mistakes. But it's also easy to forget the true counterfactuals. What would have happened had they not done the choices and made the choices that they did? In my mind, it's not inconceivable we could have had another Great Depression had they stepped in. And yes, there's a lot of intervention, a lot of things that I may not be comfortable with. But in the heat of battle, decisions are made. And now, the job of folks like you is to help us look back and assess, okay, this is how we thread the needle better next time when we do step in.
And I think you make an important point there, not to digress from our broader topics, but some of my research is really about those kind of real-time reactions and how short those windows are. So if you're trying to make judgments about saving banks or not saving banks, your policy windows are quite short. And so some of my research, again, in different contexts, going back to the Depression, really shows how quickly those deposit outflows take place. And if you don't have some sort of response, whatever your lender of last resort optimal response would be, if you don't have some sort of response to stop those outflows when there are runs taking place in the financial system, that can really cascade and spill over to other financial institutions and really, create an economic calamity, starting and, kind of emerging from the banking system and spiraling out further into the real economy.
Yeah. Well, let's tap into this knowledge, this history that you've built up and you've published. And I want to go back and use it, both your work on the historical past as well as your more current work, to really get at a fundamental question that I think I often take for granted, and I think we do on this podcast, and that is what ultimately determines or drives the price level. And it's easy, I think, if you get in your own camp to say, oh, it's monetary aggregates. If you're a monetarist, if you're maybe a fiscal theory of the price level person, it's fiscal policy or it's the expected future primary deficits. Maybe if you're a new Keynesian, it's output gaps and Phillips curves. But I think history really provides an interesting way to look at this because we can look at monetary standards like the gold standard, the silver standard, bimetallism, and you've written on that. So I want to go there. And then I want to tie that into your current research on central bank operating systems and balance sheets and what happened to the losses we saw at major central banks recently compared to the 1980s. And do balance sheets matter for the price level? And so we're going to look at these different pieces of the puzzle, put them together today. And even though there'll be very different historical periods, I think we can paint a picture, bring together, have that puzzle complete and help us make sense of what really drives the price level. Again, is it the monetary standard? Is it fiscal backing? Is it money? What else is going on here? So let's begin by going back to a topic that I don't think we've ever talked about on the show other than in passing, and that is bimetallism. So help us understand, what is bimetallism? When was it used? And why did it even emerge? Why did we have bimetallism historically?
Well, so I guess, the macro teacher in me would say we know for good reason that money has many uses. It has use functions. And, we saw these metallic standards, like when we think of bimetallism, what we have in mind is a system where, you could just be using silver and gold themselves, minting those and having those circulate, or you could be using paper currency with some sort of backing rule backed by silver and gold. And bimetallism is going to say the amount of money circulating is going to be determined by that ratio between gold and silver. And, these systems essentially emerge out of convenience, right? We want some sort of species that's going to be convenient and durable. And so we want to use it as a unit of account, as a medium of exchange, as a store of value. And, as other social scientists have written, money is a construct, it's a social construct. And so we choose things of value, and silver and gold were precious metals that had value. And so they had durability, and they're fungible. You could melt them down and change them. And of course, the issues came up over centuries. Could they be counterfeited? How should we set that ratio? Famously, Isaac Newton was the master of the mint, gets the ratio wrong, and England tips off of bimetallic standard onto a gold standard, and that starts a chain of events we'll talk about in just a moment. But it starts with this idea that you need something useful for money. And in most societies, be it cowrie shells, be it the giant stones that they use in the Yap Islands, whatever it is, there was something of cultural significance that they could designate as money, even if they then used some kind of, kind of quasi equivalent to blockchain in the case of, the Yap Island currencies. They're not moving those around. They're keeping some kind of unit of account system. So the predominant forms of something precious that began to circulate are gold and silver. And I think the initial idea was to have these have different, they had different intrinsic values to them. And so they naturally allowed monetary authorities, governments, or private issuers to kind of rank the value of silver relative to gold. And of course, you would have a market price for these things, where people could just transact in these based again on just the relative scarcities. And then you could have a mint that actually minted coins. And so the tension when you ran these metallic systems was always between what they called the mint ratio and the mint prices versus the market prices. And the challenge was to, of course, keep those things relatively close, that the master of the mint had to keep the price relatively close to that market price. And otherwise, if those things deviate, you're going to get an arbitrage opportunity. People are going to, start, if you set it too high, they're going to start melting down or taking in their metals and, converting them and getting, gold out of that and then taking it to the market. So the market pins down what the monetary authority can actually set as the price. And then the hope is that then whatever is issued then is kind of pinned down, and that in fact is going to kind of pin down the price level. So the easiest way to think about, since you want to cast it in terms of the price level, imagine a simple world where we didn't have bimetallism. Just imagine just one of these, silver or gold. You issue it, and you issue it in a fixed quantity. And so there's no backing rule. You're just circulating the coins themselves. And so that is your money. And in a monetarist interpretation, if we just think of like a quantity equation, we would have the money on the one side and the price level on the other, and your GDP being determined by long run factors like, labor force and capital and technology. And, assuming velocity is constant, you've got this nice kind of relationship, right? You put more of these coins in circulation, it's going to affect the price level. And then what the system kind of did was the markets pinned down the ability of the monetary authority to issue more. And so they could only issue once you have a backing rule and you issue notes, you could only issue notes up to whatever your backing rule was. And without a backing rule, it just meant, well, whatever gold you have, you mint into coins. And so you can also see how mercantilism, the early form of, trade policy came about. It's this kind of a function of, well, I need more coins to trade more. And so that's how those kind of, notions of early trade policy also kind of emerged, right? That kind of go hand in hand in some sense. But, the 19th century really represents the watershed for both those, right? It's the watershed for, I think you had a previous colleague of mine on a previous podcast who was talking about the emergence of the global economy. And of course, Kris Mitchener would have talked about the importance of the 19th century and kind of this first era of what we would economic historians would call globalization, the first era of globalization. And this is changing, trade relationships. So the as I'm sure he talked about, early trade agreements between the French and English kind of set the table for free trade, and with that comes the need to have currencies that are kind of going to be global. And what emerges in the 19th century over time is this slow shift, again, initially by accident with Isaac Newton and the Master of the Mint, but initially by accident that England goes onto gold, and it's kind of the first one to tip a big superpower, trade and economic and trade and geopolitical superpower of the 19th century, it tips onto gold accidentally. And then it starts pulling its most important trade partners onto gold through these kind of network effects, right? These network externalities. Yeah. And so this transition that you wanted to ask me about, this transition from bimetallism to gold, gets underway in the second half of the 19th century. And, to some extent, bimetallism received a lot of attention from monetary theorists because when they were writing, that was kind of an interesting way of kind of thinking about how prices relate to this kind of complicated system. But the gold system, I think, for many reasons, actually turned out to be a better system to support this whole new apparatus of global trade and finance that was emerging. Because in some sense, it was simpler, right? You don't have to keep track of two backing, essentially two market prices. You just keep track of one.
Going back to what you mentioned earlier about Isaac Newton setting the ratio at the mint between gold and silver, and he did that in a manner that led to gold being the medium of exchange, the form of money. And that was somewhat of an accident. He didn't mean for that. That wasn't the intention. And then, of course, Great Britain is this global power and other countries follow along. So not entirely an accident, but some part of this was some path dependence set up early. And then later, it becomes norms and countries want to follow and be civilized nations want to go on the gold standard. And then there's bimetallism in the U.S. for some time. But eventually the U.S. kind of settles on gold by the end of the 1800s. Is that correct?
Yeah, that's correct. I mean, again, kind of hearkening back to our earlier discussion, there's a strong coalition among farmers and among miners in the West that really don't want to kind of go to the gold standard. And so even as the U.S. comes off of its experiment with greenbacks and issuing unbacked notes from the Civil War, and it's called resumption in 1879, the Silverites are still quite strong in politics. They have vested regional groups that are trying to normalize the system that prevailed prior to the Civil War, and so they're able to kind of win some Pyrrhic victories, but I think their last stand was really Bryan in the election of 1896, and by that point it was pretty clear, as it was in other places around the world, such as India, which kind of, began to demonetize silver, and other holdouts, there's so throughout the, I'd say, 1870s and 1880s, you see a bunch of countries shift from bimetallism to gold. And some of these are accidents. I know you were asking about that. I mean, we could think kind of accidents. So, for example, how does Japan get its gold to go onto the gold standard? Well, they fight a war, and at the last minute, the war indemnity, they essentially the victory money they get, they demand it to be paid in gold. And this is very similar to how Germany gets the money to go on to gold. They demand it in their war, in the Franco-Prussian War. So you could call those kind of accidents or kind of negotiations, and then we want payment in gold. And now you have enough gold to back your currency, to back your note issuance. So I think there is you could call it policy plus accident or something like this. But from an economist perspective, when we look at this, we can kind of see so the other thing going on is that scholars have talked about, and I think this is most important for countries at the core of the system, that there was sort of a good housekeeping seal of approval. So this is the term Michael Bordeaux and Hugh Rockoff gave it, that at the center of the system, these economies, if you joined up to the gold, you got to borrow at a lower rate. And so from a sovereign borrowing perspective, maybe there was a benefit to joining gold. And so what was that all about? I think that'll anchor us back on our discussion about price anchors, because that was really, their argument was essentially an argument about sending a signal to markets that you're going to have fiscal probity. And you're going to have fiscal probity in part because you're going to have monetary probity through the fact that you're going to commit to a rule, right? And so all these things we're going to talk about today, the modern whether it's a Friedman rule or whether it's inflation targeting, these are all types of rules. And these rules-based systems really kind of begin with bimetallism, hence Friedman's interest in this, Milton Friedman's interest in this.
Yeah.
And then they evolve into the gold standard, which has rules. And, by accident or by design, countries climb onto this gold standard, and some of them then do benefit and see lower costs of borrowing when they join. And this is interpreted by those authors as, a signal that they're going to commit to monetary policies that are going to lead to not inflating away the bonds, the bonds you're issuing.
Yeah.
Now, the tricky part of this, and just to digress a bit, is that that really only held true at the core. And so some work I did said, let's look at emerging market countries. And I will just say, whereas some people like to put a lot of emphasis on maybe we should go back to the gold standard, look at all its stability, you're not going to find me in that camp, because if you're an emerging market economy, it was very difficult to stay on gold. And you can see this because we collected literally millions of observations of bond data, and we collected paper bonds and gold bonds. And essentially you can back out what economists call currency risk, right? It should be that differential. If the gold standard is completely credible, then your paper bond should be as good as your gold bond. And so there should be no premium in the market for holding a paper bond. And what we actually find is that even after gold standard adoption, these risk premiums were quite large, meaning markets never fully thought that these commitments to gold were credible. And that's in part because they turned out not to be credible. Many of these countries abandoned gold because it was much more difficult to be on the periphery, because you kind of, and then there's a large literature on this. You weren't the conductor of the international orchestra, as Keynes called it, right? That was happening at the center of the system, so that when a country like England or France changed its rates, in order to stay on the gold standard, other countries would have to change their discount rates. Those were the policy rates at the time, in order to prevent gold from flowing across borders and from you being forced to leave your gold standard, meaning that's going to transmit shocks from the center to the periphery that might be asymmetric or unaligned with your own business cycle.
That credibility that you bring up, I want to use it to kind of segue into this bigger point. So the markets back then had questions about the periphery. Could they credibly commit to the gold standard? And they were saying no. They don't have the fiscal capacity, the state capacity to make those tough choices to raise rates when Great Britain would raise their rates. And so I guess this is the kind of the question I want to ask you, tying together kind of all the threads from this discussion we've been having here. Was it, the metallic standard, whether it's bimetallism or gold, that really anchored the price level? Or was it the fiscal commitment behind the gold standard, the commodity standard? So in other words, during the Civil War, the U.S. goes off the gold standard, and then it commits, this journey back, as you mentioned, to 1879, this journey back. It undertakes intentionally undertakes deflation to get back to a place where it can go back on a sustainable basis, the gold standard. And so it was a signal. It was, I believe, it was credible.
Yeah.
But not every country could do that. So I guess my question is it really the gold standard, or is it a deeper institutional commitment to price stability?
Well, that's a great point. I mean, it's going to have to be both. And I think there's a third dimension that I would encourage listeners to think about, which is the policy environment and also the conceptualization of what we knew about the economy at that point in time. So to frame those, let's kind of think about, modern international economic policy. And I think the way to think about this is to use kind of Obstfeld and Taylor's framework of international policy trilemma. It's often called the unholy trinity, because you can't have these 3 points of a triangle simultaneously, which are pegged exchange rates, fixed exchange rates. That's your gold standard. That's your bimetallism. Yep. You can't have that combined with capital mobility and what you would call, independent decision-making monetary policy or autonomous monetary policy. So in the case of the gold standard, what are you sacrificing? This was an era of capital mobility, high capital mobility, very low capital controls. So they didn't sacrifice that. It was an era of pegged exchange rates. So they didn't sacrifice that. What they sacrificed was, the ability to make independent monetary decisions. So what's the other defining characteristic of the periphery, and that even, impacted core countries in, say, the early 1890s or the early 1870s, and that is financial crises. So I think, we have a tendency as monetary economists to overemphasize monetary policy. I see this all the time in policy shops like central banks. But in their stated missions, in many of them, they also are charged with financial stability. And there was a lot of financial instability on the periphery in this period. And so these choices become very challenging in part because what do you do if you have a banking crisis, right? Can you act as a lender of last resort? Are you going to create an institution, a modern central bank that actually does that? And this is an era where they're kind of sorting through that, right? We're going to see, a crisis in England called the Over and Gurney crisis, which is really going to kind of define the Bank of England and have it rethink its position as like, should it act as a lender of last resort? And we're going to see other European central banks begin to think about this role as a lender of last resort. Some of them don't even really get this resolved, and maybe we'll have time to talk about this up until the 1930s, because it actually is going to feed back into this discussion we're going to have on central bank losses. There's a very interesting episode of the French case, which I've been working on now for about 5 years with Eric Monet, a French scholar. And he and I have been kind of researching this fascinating episode of losses and lender of last resort behavior. But to keep it on target, there are trade-offs, right? Whatever trade-off you want to take, the trade-off of having pegged rates and capital mobility was you can't use your autonomous monetary policy either as a lender of last resort or maybe just to stimulate your economy. And so that's where the macroeconomic models and conceptualization come into play. Because if you don't view unemployment as a social concern, if you don't view it as something that policymakers should be concerned with, you view it as a personal shortcoming, as they did in the 19th century, then it's kind of easy to focus with laser-like precision on what we call external balance, maintaining balance of payments, stability. And that's what the gold standard was really good at, right? If you just say, put zero weight, so it's a different kind of policy function. You were talking about new Keynesian models with, weights on unemployment or the output gap and inflation, right? There, the weight is like, what kind of weight do we put on internal balance versus external balance? And the weights in the 19th century were 0 and 1. And you could do that because the franchise was limited. And so I think your best to answer this shortly, your best example to get to your question, like, is it the standard itself that delivers this credibility? It's not independent of politics. And the reason it's not independent of politics is because they try to put Humpty Dumpty back on the wall after World War I. And they create this kind of system called the gold exchange standard. Prices have risen, and because of the war, people went off the gold standard. They have to fight a war. Some of that war is financed through bonds. A lot of it's financed through just, money creation. And they're faced with this world like, well, they don't have enough gold possibly to go back on their pre-war gold backing ratios. So they kind of pyramid it, and they say, well, countries like France and the US in particular, which never went off gold during the war, they've got a lot of gold. So we'll just say if we hold their currency, it's as good as holding gold. And so that's how they take advantage of this scarce resource, right? The backing thing. They basically come up with this modern concept that a lot of EMEs use today, which is, hold global currencies as your reserve currencies. So they do this whole system, but of course the world's changed. In order to get people to fight in the war, they made political promises, and those promises included the vote. And so now you're in England and you're thinking about monetary policy, and you can't have that laser-like focus on external balance, because now if you don't think about high unemployment after World War I, which of course England has before any of, in spades. It has its depression before the Great Depression. What do you do, right? Do you respond to that, or do you get run out of office? And so, I have this view, and I think others hold this view, that particularly Barry Eichengreen, that you could maintain the singular focus on price stability when the franchise was limited. And when that changes the ability to have this anchor really work in the way you want it to. And so we can't go back in time and just say, put the gold standard in place, because
right.
We also have democracies where the franchise is much more extensive than it was historically. Right. So we might say these are great anchors, but in a very narrow sense, in a world where we didn't have full macroeconomic models and understand how the spillovers to, unemployment and incomes and production work.
Yeah, if we did go back, we would probably get the interwar gold standard, which was a big hot mess, as opposed to the classical gold standard,
right,
which worked relatively well compared to that. But the key point, I guess, you're making is, it is ultimately credibility, but politics play into that credibility, right, and what are you actually able to commit to doing,
right?
And I guess let's segue to the present, and you mentioned inflation targets. And I often have this conversation with people. They'll say, "Oh, the Fed liabilities are no longer backed by gold. If you return a dollar, you just get another dollar." But I would argue there's still an implicit backing. It's the taxpayer. It's the future tax. There are still real resources backing that. Just like gold, you go off gold, you got to have real resources to go back on gold or to support the gold standard. So I would say fundamentally that it's the same principle, even if we have a different monetary order or an approach. And I think this is a nice segue into your work on central bank balance sheets and operating losses, because as you note in this paper, and the paper's title is "Do Disinflation Policies Ravage Central Bank Finances?" And you're speaking to what we just went through, a lot of operating losses in advanced economies. And there's been other work that has also shown there's central banks can have balance sheets with negative equity. And guess what? They can still do their job.
Yeah,
it doesn't impair. Now, maybe at some point, I imagine you get enough negative equity, you're in trouble. But I think this speaks to credibility and to the belief that there's enough fiscal backing to make sure the central bank continues to do its job. So let's talk about this paper. Its motivation. We kind of touched on it, but give us the motivation behind it and what period does it cover?
Yeah, so the motivation behind it is pretty clear, as you pointed out. I mean, if we look around the world today, it's not just, one we could chalk up to weak institutions and, underdeveloped economies that have problems with, central banks that are profligate and poorly managed. It's really a problem that has infected most advanced economies' balance sheets in the early 2020s, first half of the 2020s. And that is to say that when it's kind of an underappreciated area of research. Monetary authorities would normally say, who cares, right? And we'll get into the why you should care. There's a good reason to say you shouldn't care, but just to point out the facts first, many of these advanced economies were experiencing losses. In the case of the U.S., the losses amounted to about $192 billion for 2023 and 2024 combined. You can go to the ECB, it's on the order of around $9 billion for those 2 years. And then you can go to remember each of just to remind the readers, or the listeners, Banque de France, Bundesbank, these are subunits of the ECB, but they maintain their own balance sheets, and we still see losses there in those institutions. So as you mentioned, we collect data on 10 advanced economies, many of which are having these losses. And these have gained, I think, attention in part because they're occurring alongside fiscal policy, which has, we know in kind of between the global financial crisis and present have kind of been persistently running large fiscal deficits. So when central banks are no longer remitting profits to state treasuries, that's going to, in some cases, just a limited few cases, I might even drain reserves from those treasuries. But at a minimum, it's giving policymakers maybe slightly on the fiscal side, less fiscal space because they're not getting those. And so that's where we can really say it becomes policy relevant, because when you run these negative profits, these losses, people wake up and they start
Yep.
asking questions. And that's a real political economy issue more than anything else. And so I think the best way to kind of think about this segue into this is like there's a very interesting set of political economy issues. And then there's the issue that we really set out to tackle, which is, are the losses themselves directly result of disinflationary policies? And so that was our motivation to say, when was the last, it's like we can see the balance sheets and we can see why the losses are occurring. And so is this something about institutional evolution of a central bank, or is it something about the shocks themselves? And so the motivation for this paper was to say, let's go back not quite as far in time as we just discussed, not more than 100 years, but let's just go back, 40 years or something when I was a child and try to think through the great inflation period. And then what, because macroeconomists love to call everything a shock, the Volcker shock, right? The dramatic raise in the,
named after a great central banker, Paul Volcker.
That's right. Named after Paul Volcker, and who comes in, in 1979, appointed by President Carter, and then is, facing high inflation. It had been, I think, around just under 12% in 79, and then peaks that are over 14% in 1980. And this is true, in England and France, these countries, Italy, they have similarly double-digit inflation rates. Germany, Switzerland, economies like that, they have much higher inflation rates than they were historically having, but lower than these other sets of countries. So we have a mix of countries here, but this is a great period to go back to and say, like, well, we can kind of separate out two things. Like, we can try to figure out, is it the way that balance sheets have evolved that's leading to these things, or is it the actual tightening process itself, the process of hiking up interest rates in the U.S. case, short-term rates, peak at around 20%. Does that end up affecting the balance sheets themselves, or is it other factors on the way that monetary policy is being conducted today that lead to these losses? And so we go back to that period in part because it was a big inflation shock. It was the last big inflation shock. And it's also better than earlier ones like the 20s or 40s, in part because we know other things were going on, like price controls and, factors that would make it difficult to identify these two channels. So that was the motivation, just to answer your first question.
Okay, so we are in a period that is similar to what we went through in the following sense that we have a surge of inflation. Now, in the more recent period, it was quick, it was sudden.
Right.
But, we had rapid inflation in 21, 22, and so the Fed had to respond aggressively. And what you're saying is, okay, let's go to another period where something similar happened. We had a big inflation surge. Now, this took longer to build up, but Paul Volcker comes in and aggressively addresses it, just like the Fed aggressively addressed it, under Chair Powell the past few years. So we got two Fed chairs, we got two inflation episodes, we got two rate hikes,
right?
Aggressive rate hikes, and then what does that tell us about the differences in operating losses and profits? Now, we know we had significant operating losses, over the past few years. What happened to operating profits or losses during Volcker's period?
Yeah, it's nice to start. Thank you for starting with that, because that's kind of the key. One set of key takeaways is this is in some sense an accounting exercise. And so you might say, oh, that accounting is about as exciting as watching paint dry on a wall.
Oh,
right?
But it is exciting.
But this is interesting because, in fact, just the stylized facts, just the summary statistics show that, like, our measures of profitability are things like, it's not a firm, it's a central bank. So we use measures like return on assets and an equity to asset ratio. And, the return on assets goes, pre-Volcker, it averaged across these 10 economies, advanced economies, about 2%, and then it goes up to about 3.4%. That's the return on assets. And your equity to asset ratio almost triples. It goes from around 6% to just under 18%. So that suggests right there, maybe it has nothing to do with disinflation in and of itself, right? That makes it. And maybe it's the types of operations you have in place that are going to matter for this. And so, our our approach to this was twofold. First, these balance sheets sound simple, right? Just pluck them off the internet and use them. Not so simple. Our study period is 1970 to 1990, these 2 decades. The balance sheets aren't harmonized. So that harmonization started in 1990. So other studies that have worked with looking at central bank losses and profits begin in 1990 because the IMF started encouraging harmonization of central bank balance sheets. We had to do all that harmonization ourselves to come up with the right balance sheet category. So contribution number 1 was just a pure data contribution, which is say, let's try to treat apples like apples and oranges like oranges and figure out, where do central banks get their revenues, and what are their assets and what are the liabilities, and how do we manage these? So that's contribution number 1. Now, related to this, what we try to then do is say, okay, if the underlying data, the summary statistics suggests that, and in addition to this, not only did the equity asset ratio and return to assets go up, central banks actually made slightly higher transfers as a share of GDP back to the governments. So if you think about, obligations, like the Fed has a system where first they pay dividends out to the shareholders of the Fed system. We can talk about that if your listeners and viewers want to know more about that. But they pay 6% or the highest rate on treasuries, depending on the last auction, depending on what kind of bank you are. And then they top off their surplus, and then they remit the rest to the treasury. What I'm saying is those remittances to treasuries, plural, across these banks went up slightly, right? So that part also went up, right?
That's
so
a good sign.
Everything seems to have gone in one direction. So then then the question, the puzzle to us is like, okay, so let's play counterfactual history. What if we take a modern day central bank and give a bank historically the characteristics of a modern day central bank? And we do this on 3 margins, the 3 margins that we all would, your avid listeners would think about first. It's like, okay, so let's go through these. Like, the first is, okay, well, what about the way the Fed conducts monetary policy today? That was clearly different from the 1970s. So to remind our audience, back then, we had a corridor system, and the corridor system consisted of, a reserve requirement where essentially commercial banks are mandated to hold reserves, and then a policy rate, like a discount rate. And the Fed is going to be the outlier in our sample period. They're the only one that's really using open market operations. All these other central banks, they're still primarily targeting the discount window rate. So that discount rate is, again, the borrowed reserve rate that commercial banks can come and borrow from. So today we've got the floor system, right? And I'm sure you've had many podcasts and videos on this. And the floor system means we're paying interest to these banks. So the first thing we're going to do is we're going to allow central banks in the 70s and 80s to have remunerated reserves. We're going to put in a floor type of system. The other thing we're going to do is we're going to allow their balance sheets to be much larger. So we're going to let the reserves of the central bank grow. And then the third thing we're going to do is allow the legacy of things like quantitative easing to affect the balance sheets. And so by there, what we have in mind from a balance sheet perspective is we're going to change the maturity of the assets, the duration of the assets, as well as the rate of return. So we know that the QE assets GFC assets, global financial crisis assets, were acquired in a period of very low interest rates with longer maturities on average. So comparing maturities today, Fed's portfolio has average maturity of about 6 years. Back then, it was about 3 years. And then importantly, the rates of return on these assets is going to look a lot different. So the assets today average around, 1%, and are locked in for longer periods of time. And back then, shorter term assets, so not locked in as long, and also higher rates of return, right? So starting in the range of 5 to 6%. And then when the Fed starts changing rates and the portfolio starts turning over, you're getting, returns on treasuries like 9, 10%. So those are the margins we're going to kind of think through. And these are the counterfactuals, the what if scenarios we're going to use to kind of pin down, what's going on? Why is it that losses occur today and didn't happen given we have these two disinflationary episodes?
And so once you do this counterfactual exercise, what is it that you find that explains why we have the losses today that we do?
Right. So it's a triple threat. It takes all three. As it turns out, you can't kill off the profits of the banks back in the 70s, late 70s, pre-Volcker shock, through the Volcker shock. You can't kill it off just through reserve remuneration. So we can take that parameter in our model and we can raise that rate all the way up to essentially the ceiling rate, the discount rate, the average discount rate. And you can reduce the ROA by about 1 percentage point off of an average of about 4.5 to 5 across our sample. So that it's not that it doesn't matter. It matters, of course. It's just not enough to kill it all off. And then you add in that balance sheet size. So we actually double the balance sheet. So why do we double it? Because the Fed was at around 16%, and now it's around 42%. Assets on its balance sheets coming from the reserves.
As a percent of GDP, or
no, as a percent of its assets.
Its assets, okay.
Yeah. Sorry, I should be more clear there. So the reserves account for. So we're thinking about the reserve. The Fed today is on the flat part of the demand function, right? It's an ample reserves environment. So it's way out there. And so we're thinking about in a world in which we have ample reserves as opposed to being on the vertical section of the demand curve. In that world out here, that's about 42% of all assets, as opposed to back when we were on the vertical thing, we're around 16% of all assets.
Yeah.
On the Fed's balance sheet, not relative to GDP. And that is, and so that's essentially like a doubling on average. And we plug that in, that'll cut it down. That'll double the size of that. So it'll take another percentage point off. But to get it to go negative, you've really got to also give it this legacy of the, GFC, of QE, and of the COVID, what we would call almost like a maturity mismatch on the central bank's balance sheet. It looks like that, right? And so, you kind of get this picture of central banks now with if they're sailing ships, they've got giant sails now, right? And the sails are the size of their balance sheets. And then, those sails can be very useful because those are the things that allow us to deal with these shocks that come along, right? Like, we got to have emergency operations to deal with all these crises that hit our economy. But then those sails, because they're so large, if a big shift in wind comes, and that's what I would like you to think of as a rate change, that sail's going to push your ship in a new direction, right? So living here in the Bay Area and running and riding my bike along the bay, I like to watch these sailboats and watch the wind push them. And that's essentially what you have when you have a bigger sail, right? And so that's in a sense, you get this legacy balance sheet because of all the action that's gone on recently. And that's going to make you subject to these, these rapid, as you pointed out, it's a very rapid change in rates. And so that's essentially that in a nutshell, what we find that it is really kind of a legacy of balance sheets, and it's a legacy of an evolution of how the central banks around the world have moved to an ample reserves framework and, to paying interest on reserves. And that's kind of driving these losses. So, but not the disinflation itself per se.
Right. And so this raises several questions. Well, one observation to start off with before we get to the questions, this tells me that, we can keep interest on reserves even if we went back to a corridor system where you'd have your target rate in the middle and you had interest on reserves below that.
Right.
You could still have a positive or negative, depending where you move your rates, like based on a Taylor rule. You don't, pre-2008, that bottom was set at zero. I mean, effectively, interest on reserves is zero. But what you're telling me is, even if it's positive, you can still keep it, and it should not lead to losses for the Fed in terms of operating.
I think from a policy debate, because there's, this is a really contentious area of policy, and I don't have work on this particular thing, so I'll just kind of state it. But, there's a lot of debate on whether these, whether this whether we should retreat to the corridor system. And that's complicated, right? You might have even had guests on to speak about this. But one of the arguments you hear made is like, well, this is like an implicit subsidy to the banks, and it's a large subsidy. So there's, a paper that was presented at Brookings on this, by Jonathan Hughes and co-author Josh Younger. Yeah. And so they come up with this calculation, but there was quite a bit of pushback on the panel from, folks like Bill English, who would say like, well, look, some of this, we need to separate QE from the interest on reserves. And so one way we could approach this kind of sensibly is to say like some of what we're really can kind of show very clearly is balance sheets are large, partly because of QE. And, part of it is also this paying interest on reserves, distorts things. But those are kind of two separate things. So in a sense, we could remove the QE part of the balance sheet, is maybe a different way of answering the question, and still practice interest on reserves.
Yes.
With a much more constrained balance sheet than what we presently have.
Yeah, that's the point I'm making, is that I think it would be important to keep interest on reserves as a flexible lever that we can move up and down, even with the scarce reserve system. Because most central banks around the world have, whether it's an ample reserve or scarce reserve or even a ceiling system, they have a ceiling and they got a floor, and they're moving those things around based on, again, like a Taylor rule.
Right.
And so I would not want us to go back to like a pre-2008 where we just don't pay interest on reserves, and it's effectively set at zero. I'd want one that allows us to have a symmetric, movement around some target. The point you raised about the paper that was given at Brookings, I would also just note that if banks weren't holding all these reserves, they would probably be holding treasuries, which would be money funded from the government, going from the government to the banks as well. The only, I think, argument one can make is to the extent interest on reserves is higher than like a T-bill. And that there is some evidence, but it's not much. It's a small drop in the bucket. So I agree with you that
you would think arbitrage conditions should keep that from happening. I mean, that's the other argument that's often made. It's like, this is like distorting the rates somehow. I mean, we are losing market signals to some extent if banks.
No, I'm sympathetic on that point.
If banks are underutilizing like the overnight lending purpose of it. Yeah, we're losing market signals there. I think that's true. But I think also like you can, on the other hand, you can say like, well, Friedman would have said that you're eliminating shoe leather costs in a way, right? The
Friedman rule.
The Friedman rule is like eliminating the opportunity cost for banks to hold the most liquid safe assets. And then this again spills back over into other objectives of the Fed. If you care about financial stability, then maybe what you're doing here is you're actually encouraging reserve management. Given that we have things like liquidity cover ratios and stuff, banks have to think about these things all in the kind of like stew of all regulations that they're confronted with. So thinking about these things in isolation, as we like to do in our models, can, lead us to kind of like forget that there's a variety of things that commercial banks are having to optimize around. And so I actually think, there's maybe some benefits, as I think Lori Logan at the Dallas Fed has pointed out, there's maybe some benefits here to having this system that encourages banks to kind of think about what the optimal amount of liquidity you want to hold is, given you have these liquidity cover ratios. So
well, Lori Logan will be very happy to hear you say that, since I know she loves the ample reserve system.
I'm just saying there's like different sides of this debate, and like I said,
for sure,
I have no horse in the race, so I think it's useful.
We'll save that conversation for some other podcasts. We have had people debate this on the podcast. Where I want to land the plane though is that I do think it's important to recognize that ceiling facilities, the discount window, sending repo operations, that's important. The floor facilities are important. The deposit rate at the central bank is important. And we want to make both of those very functional. And right now we struggle more with our ceiling facilities. There's a lot of stigma about using that. So
that's right.
I think there's room
stigma wasn't there in the past too, right?
And so I think it is useful to have these conversations, and I would encourage the Fed to have a review of its operating system. And we've talked about this again on previous shows. So I think this is all really important and fascinating. So we will save for another podcast this conversation about what is the optimal operating system, the optimal size of the balance sheet. But at the end of the day, again, the framing of this podcast was what really anchors the price level. And we talked about earlier credibility, like whether you went off the gold standard or not, it was this credibility. Could you commit, and get back on it? Did the market believe you could actually garner the real resources as a government? And part of your paper, you noted some examples of foreign exchange during this period where there were some losses there, yet they also did not seem to impair. So maybe in closing, Kris, if you can tie this back into what really anchors the price level and why this credibility component is so important.
Yeah, I think that's ultimately what we see in broader studies that have looked at recent losses in central banks across like a broader set of countries, that central banks like to report positive profits or non-negative profits, in part because they are ultimately very concerned about the political perceptions of running losses. And in part that then fundamentally relates to questions around independence. And once you get to questions about independence, that raises the specter that monetary policy will have some other, purpose other than just to achieve a mandate like the Fed has or many central banks have to maintain price stability. And so ultimately, I think central bankers see this issue as much as about politics as anything, that running losses is optically challenging because it could then cause their overseers, usually Congress or legislative branch or the executive branch, to sniff around and say, are you doing your job properly? And to raise questions about if you're making losses, then maybe that means you also aren't doing monetary policy correctly. And we've seen that rules-based monetary policy works best when it's transparent and credible. And I think, our lessons, if we want to compare another lesson outside my paper, but one where I'm sure many of your audience, many of your listeners and audience is familiar with, is that when we just think about the degree to which the Fed had to raise rates recently, given the inflation shock, versus what I was talking about earlier today with the rate going up to 20%, just look at the changes, right? A lot of the reason the Fed could raise rates so little is because Volcker existed. The counterfactual of not having Volcker was we didn't have the credibility revolution in central banking yet. And so the credibility in central banking revolution in this country really kind of starts with Volcker and being tough on inflation. And so what do we know happened recently? We know, like with the COVID shock, markets started anticipating what the Fed was going to do, and they started doing the work for the Fed already. They started raising long-term rates even before the Fed, and we could argue whether the Fed was too slow, but that's a debate for another day, which I'm sure you've had. But the point is that markets started doing the work for the Fed because they believed the Fed would do it, because the monetary policy is credible. And so things that undermine the credibility are things like running losses on your central bank balance sheet, right? So independent of these issues about interest on reserves and other things, I think why these losses to my co-authors and me are so interesting is because they really are about institutional design. And if we had another hour, I would try to convince you and your audience that it's not only about central bank independence matters for monetary policy, it also matters for lender of last resort policy. And so you'll have to wait for my new book on that Eric Monet and I are working on, that's going to talk about this issue in the context of France in the 1930s, where central banks lost that independence through their voting structure, and how that led to preferential lending and led to the largest banking crisis in French history, as well as the first ever bank to be bailed out in French history. And I'll put it to you, David, a great student of history. What bank was that? It's a leading question. The central bank. The first bank failed out in French history of any notoriety was the Banque de France. And so
Napoleon's bank, huh?
our book is going to explain why, these issues around independence really aren't just limited to operational functions that economists who write down simple monetary models like the study, they're really related to all the functions of a central bank. And so, this is what got us interested in this in some sense. And so now we have two projects, one exploring France and one now collecting all the losses back through time, and to try to think through why these losses occur and how we can categorize the losses. And so we're going back to the earliest central banks and really trying to catalog these. So because we think there are important institutional design issues, just as, our earlier comments on the accidents around bimetallism and the gold standard point out, institutional design, or the gold exchange standard in the interwar period, they point out how important the way we shape our monetary institutions matters. So,
well, on that high note, our time is up. Our guest today has been Kris Mitchener. Kris, thank you so much for coming on the program.
My pleasure. Thank you so much. It's been a pleasure, and I look forward to staying in touch.